Andrew Horowitz, thanks so much for joining us again on Wall Street Unplugged.
Hey, Frank, you're looking good. Look at you. Lost all that weight. Happy New Year. You did a lot of work on you did a lot of work on your bod, didn't you? You did some kind of crazy crunch fitness, something or other, something.
Yes, and I'll never do it again. I don't know how people do it, man. It's like I really went like no salt, no bread, no nothing, and I mean I was forgetting things. I hated everybody. I hated everything, and then I gained about a good 7 pounds back, which I needed, but I lost like 22, and I think it's like a month and a half or something like that.
Are you a nicer person now that you're fatter?
Yes. All fat people are happy, right? I mean, that's a fact.
We're all happy. We're all happy.
Yeah, absolutely. I like seeing you, purple background. I wore my purple shirt for you today. I think this is purple. I'm a little colorblind.
Thank you.
But
looking good.
Looking good. So let's start, since you're the one that I turn to who has all the answers, right? The market.
Oh, I don't think
so. What's going on here? I mean, we have the blue wave now, which was a surprise, right? I mean, we didn't expect it. The markets didn't expect it. All the research companies came out, all sell-side firms came out immediately the next day with, adjusting their portfolios. But, it's not so much whether the S&P 500 is going, people thought it would crash or it wouldn't crash. Or whatever. It's more that it's a rotation, right? So we've seen infrastructure names, environmental names. Oh, man. I mean, even cyclicals that trade, power, batteries, wind, solar. I mean, can these moves be sustained? Because we're seeing these stocks move not just like 25% higher, but they're going up like 2, 3, 4x in a couple of weeks.
Yeah.
It's getting insane, right?
Right. Well, I mean, listen, I think it was an excuse for the opportunity for all those people that were looking for the value play, that reversion trade into the energies, the banks, financials, maybe some of the staples, to say, hey, this is it. Because what's going to happen is we're going to get massive amounts of stimulus dumped on us. That's the theory, right? That we're going to have a blue wave and we're going to have a massive amount of stimulus that's dumped upon us in the form of fiscal stimulus, which is very direct rather than monetary stimulus. And that we're going to see infrastructure plays happening. We're going to see Green New Deals. We're going to see all this happening. And almost in lockstep, you can look at what's happening with those sectors, and they've done more than very well. They've done extraordinarily well leading up until the election as people were getting their situation placed into their bets. And after the election, when they found out what was actually hopefully the final, we'll see in a few weeks what the final is, but the final results of this whole thing. And and on top of that, when you saw the Georgia runoff and the fact that there was going to be a tie in the Senate and that Vice President-elect Harris is going to be the tiebreaker, everybody's like, all right, well, we just better get in on this trade. What's funny, Frank, is that if you think about all the negative issues that go along with the same side of this narrative, which is, okay, if we have this blue wave that comes on, or if we have the Democrats come in, they're going to want to roll back some of the regulatory easings that were done. They're going to want to increase corporate taxes, and that's going to be bad for earnings. But everybody seems to be ignoring all of that. They're going to want to break up Facebook and Google and Apple and Amazon and anybody that has a lot of money. And billionaires are going to be like, "Oh, you should not be a billionaire, you bad person." and that's kind of like, well, those don't seem to be really, they're lagging a bit. No question. Listen, the large cap growth side of the equation is down marginally for the year. The large cap value side of the equation, when you look at the Russell 1000, is up for the year. Mm-hmm. So there's definitely been a turn this year and in December. But I just think it's people are looking for an excuse that they need to find a place for their money. And they think that, after a 30% differential between growth and value last year, that maybe this will be the thing that swings it in favor of the value. So they're pushing money in it like crazy.
I know, and just like crazy, and you're right what you said earlier. It seems like anyone that has their own company and does well is like the enemy now. I don't know how that happened.
Bad people. Bad people. How dare you be successful, Frank?
Yes, in America, it gives you the opportunity to be successful, but don't be too successful. Right. Don't you dare be too successful, right? But when I look at this and just going over some of these stocks, I looked at and I got guys, for Curzio Research YouTube page, we have videos. You could see my ugly face and Andrew's beautiful face. But I'm just showing charts. This is 3D systems. This is 5 days. I mean, this thing was like at 11 and it went to 30. I mean, you're looking at what is a Plug Power? Some of these names, right, Andrew? I mean,
no, go look at pull up SSYS. That's the other 3D printer, Stratasys.
Yeah, Stratasys.
SSYS
portfolio and sold a little too early. Oh, don't remind me. But yeah, and this is another one when you look at 5 days, right? I mean, it's some of these moves are just
amazing.
Insane. They're insane. So it's for me, like when I look at this and where these things are going, like I said earlier, is it the rotation into this? Obviously, environmental friendly, marijuana stocks are taking off. A lot of these names taking off. But as someone who recommends stocks and has your clients, what are you telling them in this market? Because there's that FOMO, fear of missing out, right? And we all have it. So, but yet, if you buy these things at these levels and you're wrong, I mean, not you and I, because we own our own companies, but if you think about institutions that hire these managers, if you're going into these things, they could drop 25, 30% because they're up 200-300. Look at Zoom. Zoom was like 600. Isn't it like three and change now? So, how do you play this? And are you able to find new ideas in this market where it seems like, a lot of stuff's going up?
So one of the things is we have we use different strategies for different things. But one of the things is that has kept us, I would say, in good stead with our clients is that one of the strategies that we use for picking stocks is a fundamental screen that is not emotional. It doesn't look for, and it's not going to find names that have no earnings that are just moving up. That's just not going to happen in the screen. But one of the things that happens is that we find a number of stocks that meet certain criteria, like growth of earnings, growth of revenue, margin expansion, high ROE, certain volume trading, et cetera. And one of the things that happens is when we get a certain number of companies that come through that screen, we invest in them. But when we find there's only a small amount, maybe 20 stocks that meet that screening criteria, we reduce down our overall portfolio allocation to equities. And when it expands, we expand it also. Interestingly enough, right now there was only about 33 names that came through that in the last quarter, which gives us about a 45% equity allocation. Well, that's not a full allocation towards equities because there's something not right with the fundamentals. We're not seeing a matchup of the collars and the cuffs, so to speak. One of the problems is that this whole narrative, this is really the core of this, Frank. I think that this is the core of the discussion. The narrative has been that it's okay to have 23 times forward earnings on the S&P 500 or whatever stock that you choose or whatever index you choose, if in fact we have low rates. When we have historically low interest rates on treasuries and on bonds, et cetera, down at 0.5, 0.6 or so, on the 10-year, hey, you know what? It's justified because it's a risk-free rate of return. You use it in your calculations. You come out with a discount factor that, of course, more favors those companies that are growing, and then you can give them a higher multiple factor. Well, what's really interesting right now is we've seen that the 10-year has gone from, 0.5 or so to like 1.17.
Yeah.
Now, that's still low, right?
Mm-hmm.
But that narrative has now changed. The narrative is now, it's okay. It's still low, but even though it's increased substantially, we could still justify these levels of price earnings multiples because, you know what? That means that the economy is doing better and rates are naturally going to come up. The problem is you can't have both sides of this equation and both sides of the discussion yielding the same outcome. It's impossible.
No, it is. And just to see the rise just in the past month in the 10-year, which I'm showing, but and that leads me to my next question, because you and I love economics. We love the economy. I think you do a great job. I like doing it too, where, when you say the economy, think bell curves. It's hard to take a class like that, but the economy is really about everything that we do, everything we buy. You get your next door neighbor selling their house, how much you're paying for milk,
right?
How many people are getting new cars. I mean, it's a lot of fun when you look at it that way. You can really see firsthand, not have to be an economist, of what's going on. Does these stats mean anything anymore? I mean, we had bad jobless reports. We had, manufacturing not that good. Does it matter, since it seems like even the worse we get, the Fed is just going to be there and spending trillions,
right? Where,
that's the Kool-Aid. You have to drink it. If not, then you're going to be sitting on the sidelines watching this go higher. But I mean, the economic data, I feel like it's kind of useless over the past 3-4 months, where it doesn't even matter, right?
It doesn't matter. I mean, Everybody has been really concerned and riled up about, oh my gosh, we're going to have socialism if the Democrats come in, right? And we're going to socialize everything. Listen, we have socialized our financial systems over the last 10 years really well, actually 12 years or so. And in this last go round, all those people that were crying they don't want socialism, to be honest with you, you should be very thankful that the government came in with the PPP programs, with the unemployment compensation, with direct checks. I mean, if anything else, if we have nothing else, aren't direct payments to citizens a form of socialized finance? Right? You take taxes and you send it out.
Yeah.
And what we've done is basically, as we've done before, we've plugged the hole that was made by a financial crisis. And if you're in the, I would say, 35-year-old range, and when you started investing and maybe saw the collapse back in 2008, 2009, and then you saw that the Fed and the government came to the rescue to bail out the banks, to bail out the businesses, and to bail you out. And now fast forward to 2020, when we had a different, but yet a financial meltdown, and the Fed came in to rescue the day, and we saw that along the way, the fiscal stimulus and the trillions of dollars, and the last $900 billion was simply a down payment on the next amount that's coming out. You're thinking, hey, what is there really risk in? Is there really risk in the markets? Because at the end of the day, what's going to happen is that the Fed or the government's going to bail everybody out. Nobody fails. But there is eventually going to be something. And one of the but when, right?
When does it end?
It can't end now. It ends in either. No, it ends in mutually assured destruction from an economic standpoint around the world if anybody lets up, because you have now pulled forward this technology, incredible technology that has allowed for companies to increase margins with less employees, never needing to have those employees back. And this nonsense that, it's a fungible situation where you have the ability for workers that were working on, construction to all of a sudden enter the technology field now. That's not going to happen. The amount of training that needs to happen and all that is ridiculous. So the thing is that right now, economics don't matter. We saw that jobs number somehow magically we're 6.7%, which were really a lot higher if you don't do all the statistical shenanigans that go on to calculate the labor participation rate. And then you saw a loss of 150,000 plus last month in December. Nobody blinked because they realized the worse the numbers get, the more opportunity we have for the government to stand in. And the last go round of the $600 per week unemployment gave a lot of people more money and fixed their balance sheets. It was like I hate to say this, but as terrible as this is, it's terrible. So forgive me in advance. It was like a gift from heaven, this whole lockdown, where the governments felt so bad that they just plowed money, more money to some places that needed, less money to others, more money to individuals that were needed, less to others. But in the meantime, they've continued on. And that's why the retail sector is doing so incredibly well. Who would have thought? All these people out of work, millions of people out of work. Restaurants are coming back very strong. Shake Shack hit like a new 52-week high today. You look at even the cruise lines who keep on postponing their launches are up 50, 60% from their lows.
Yeah.
Planes getting all sorts of bailout money. So it's here to stay. Unfortunately, there's no point in really relying on the economics other than as a sideline to understanding what the big picture is.
So we just talked about when does this end? We're seeing the 10-year rise, which, if it keeps rising, that's bad, right? You're going to see the Fed, what I've been saying, they're going to use yield curve control. Even Gunlock, who was on TV yesterday, Bond King, said the same thing.
Yep.
They can't have those rates rise, which is going into short-term rates, right? So now we look at short-term rates, which they're keeping low, and they're going to keep low, it seems like, forever. But remember, they have that magical 2% inflation target where, we want to see it around 2%. And again, everyone out there, we know that you're seeing inflation in freaking everything that you buy, but it doesn't matter because the Fed looks at the CPI. That's all they look at. So, by the way, the 2%, when they first said that? 2012. And we have
2%. And not only that, everybody around the world has adopted this. Yeah. And what does that number mean? It's this arbitrary number that they just can't get to. And by the way, if they got to 2%, like they were thinking they were going to, they already changed they moved the goalpost. They moved the goalpost.
But we're on 3% because this is different from TARP, right? And just someone follow the economy. I mean, TARP, when we did, it was $700 billion, $750 billion, turned out to be less than $500 billion, like $470, $480. That went directly to the banks to stabilize the system. That was different.
Directly.
This is going this isn't going to the economy, and this is going like a check you're getting in the mail. I mean, this goes right into the. This is, for you not to see inflation skyrocket over the next 12 months, I would be extremely surprised. I just don't know if that's going to be the death of all this, where, okay, inflation goes to 3.5%, 4%. What are you going to do? Long-term rates start with what are you going to do? Because, eventually you're going to remove the punch bowl and that premium on so many stocks, which some deserve. You mentioned there's winners that from COVID that, hey, the government said, hey, you know what? Walmart, Target, Home Depot, you guys can stay open, but nobody, they pick and choose, which is fine, right? It's crazy to think about. But it is interesting to see how this will blow up. Now, I think we both agree on that from what we've been talking about, but let's talk about this year, right? Maybe we don't see inflation like skyrocket, this year, but we still have these underlying positive currents, right? That are creating a tailwind for equities.
Right.
What are some of the sectors, stocks that you see, that could benefit? Because a lot of these things are 52-week highs, which means you're going to have to take on a lot more risk to buy these things than usual. Yeah. But is that potential upside still there?
I mean, you have a low dollar. Listen, there is inflation. We have wealth inflation going on right now. Listen, there was more. This is fascinating. During the whole COVID lockdown and during the last 8 months or so, there's been more retail accounts opened with either Robinhood or Schwab or TD Ameritrade or E-Trade or name your particular interactive brokers. You name it, they're backed up. I know this because I'm in the business, and I know that they've taken people off the desk from service to go into new accounts because they just can't handle the flow. One of the amazing things that I heard recently was that one of the biggest deposits the similarities in deposits over the last number of months have been the incremental amounts that have been put in that have been like very apparent. $300 and $600. $300 and $600 were the most often incremental amounts that were put into accounts. Now, where's the significance there? That's from your extended payroll, unemployment, or your unemployment compensation that was put in. So people are taking all this money and putting it into the markets. That's what's been happening. They're putting it into Bitcoin or various cryptocurrencies or whatever they're putting it into. And they're definitely buying the SPACs. They're buying the EV names. We have a dollar that seems to be going down, and the potential for, as we have such a terrible situation here, probably another 20 or 18 months until we get fully vaccinated. If we get to that point here in the US, it's not going away tomorrow. And people still having this post-virus stress disorder, the PTSD that I've talked about. And they're spending, they're doing differently. So what they're doing right now is everybody's really all hyped up about the idea that, hey, you know what? Electric vehicles are really hot. Charging stations like a Blink, an SBE are really doing very well. You mentioned Plug Power, which is hydrogen-based. They got a deal out of Denmark today. They got something out of South Korea a couple of weeks ago. Their stock is up by some multiple of something. It's gigantic numbers. You see the Tesla, which keeps on going up, which numbers defy gravity entirely. But what we see is right now that the potential, what's really fascinating is the energy sector is also moving up dramatically with everybody cheering on electric vehicles.
That to me. Explain that to me. Like more electric vehicles, right? So you're seeing less supply. We also have an administration that said that they're against fracking. Okay, maybe on federal land or whatever, but it's going to result in fuel wells being drilled, not right now, but there's just a massive supply right now. We have, most businesses closed. Most major cities are still freaking closed. This move in oil is kind of incredible. I mean, I don't know.
It's all OPEC. It's all OPEC. Listen, you know this. Oil is all supply and demand.
Yeah.
Yeah, but everybody knew they were going to have to do a production cut. And the fact is that it's all supply demand on oil. The idea that things are opening up, everybody's going to start traveling again is something. But I think that the clampdown on, it's artificial. It's not really demand. It's supply constraint in the form of what they did with the production cuts, and everybody's just hopping on board. And listen, the other day, Elon, let me just give you the summation of everything that's going on in one quick story. The other day, Elon Musk, he mentioned something about use Signal. He kind of puts these cryptic Twitter messages out there. He said, use Signal and this stock. I'm not going to mention the stock name, stock symbol, but this stock went up, named Symbol Medical Devices or something like that. Signal Medical Devices was up like 600% in the 3 days because everybody was thinking that he said that. This is one employee, no revenue stock that was a penny stock that was up like 600%. It's down like 60% today when everybody finally realized, oh, that's not what he was talking about, was that stock.
Yeah, that is funny. He was talking about Signal. I use Signal, so basically it's like encrypted and everything disappears and it's more safe. And Yeah. So
everybody is looking for the next big winner because they're there. The speculation is high. We see it in the crypto market. We see it in the EV market. We see it in the SPAC market. Then we have on top of this a lot of these guys that are doing the SPACs that they have this godlike image of themselves that they're making everybody wealth. I mean, look at some of the guys that have been talking about this, and they're like, "Oh, hey, stay with me. We'll make all this money," and coming, with all these nonsense numbers, bringing in companies into the SPAC that was prior bankrupt. Look at what Fisker, for example. Look at Lordstown. Look at all these different names that are being pushed into these SPACs, and you have to question: are they making money? Are they ever going to make any money? But once they have the word SPAC slapped on them, they're up 40, 50% in a day. And they keep on riding from there. And you see companies like that are coming public, in the DoorDash, which is up 16, 17% today, moving incredibly. And you see Airbnb starting to recover after DoorDash just blew out, came right down, smoked right back up to the top because people are thinking, you know what? I need to make money. This is the way to do it. There is an absolute stock frenzy going on. You don't want to call it a bubble, whatever, but come on, let's face it. There is a frenzy going on because there's too much money out there that needs to be shoved into somewhere. Tina is alive and well. There is no other alternative. And the fact is that people are saying, yeah, I'm watching everybody else make money. I had a CPA I talked to this week. He says, you know what? I pulled all my money out in December. I'm done. I'm not doing this because I got my money back. I put it for my 401k, but he said these valuations make no sense. And a CPA, a valuation guy. Okay. He says, but I'm thinking about buying Tesla. I said, what? What do you mean? Seriously. I'm not kidding. I had this conversation. He said, I'm going to buy Tesla.
Very quickly. Yeah.
Yeah. I said, what do you mean? He said, well, I'm going to buy Tesla because I think, everybody that I know has it. They're always talking about it. And what's the worst that can happen? I don't know about the valuation, but maybe it'll go up to $1,000 or something like that. I'll make a few bucks out. I said, wait. What about the valuation? He says, yeah, I know, but. So that's kind of the story that's going on. There's nothing wrong with it. It's musical chairs. As long as you have a chair when the music stops, you're in good shape, right? But in the meantime, have fun.
Frenzy?
What do you mean?
Think there's a frenzy out there. I mean, look at this signal advance, what you were saying.
Yeah, what's it down today?
This is the 1 month chart, but look at the 5-day chart. So this is where Elon Musk, it was at $6 and it went to 40 in like a couple of hours. And even now it's down 60%.
It was $6. It wasn't 6 cents.
But
it was $6 or 60 cents.
Oh, I don't know. I think it was, this is 60. Well, it was but it was 60 cents on the 7th. Right. On the 7th. And then it went up to $6 a couple days, by the 8th. And then on the 11th, it was 40. It's still 15 right now. It's still 15, even though it's still 15. 60 cents, right? But nobody cares. But there's no frenzy. What are you talking about? There's nothing out there. But it makes it difficult because my nephew is young, and I'm interviewing him after us, and he plays options. He's on Robinhood, and I want people to understand that because options are very difficult. It puts a time value. So even if you're writing your thesis, if you're not right in the right time frame, you're going to get crushed. And he got crushed in a couple of days. He was making money, but I think there's this thing out there where people can just go on Robinhood and you're going to make money and you're going to do fine. But that fear of missing out creates those emotions when you're younger where, he had Tesla and it entered the S&P 500 and he had calls on it. And, the following that Monday, it opened up down. So he sold it for like a small gain. If he kept it, he would have made like, 30,000 on, whatever, like $1,000 bet or whatever.
Right.
That's what he's thinking. He's not thinking, wow, I made like 30%. But this market, is it going to result in what we see during these times where, the Robinhood accounts, the young investors, because right now it's difficult for seasoned investors, managers to really tell them, hey, what are you doing wrong? Because these kids are actually making money because they're buying all these, but they keep going higher and higher. They're buying on rumors and after the news and still making money. So it's kind of crazy environment.
Because everybody, listen, Robinhood has gamified the whole process of investing, and that's fine. Listen, it's all about making money. I am not a believer, everybody knows this, in the store of value or the currency concept for Bitcoin. I am not. So you want to throw pies? Hold it before you throw the pie. Let me say something. However, as an investment, have at it. I'm all over it. You want to invest in it. You want to work it. You want to have it for short-term, midterm, whatever. But let's not kind of get into the whole idea that this is a religion. That, there is something different going on here than has gone on with any other asset in the past, especially these new assets. There's a small amount of overall liquidity in it, so that helps to push the price around pretty much. And I'm not talking about any of the other coins or anything else. I'm just talking about the concept of Bitcoin. So, when it comes to the investing here too, if it's moving up, if you're making money, if you're doing it for a short-term trade or even a swing trade, whatever it may be, and it doesn't make any money, in fact, is maybe losing money, or maybe it's even bankrupt like a Kodak that everybody was chasing. Remember that one?
I do remember Kodak.
Have at it.
I remember it very well.
Have at it.
I was at the Consumer Electronics Show.
Hertz was the one. Hertz.
This time, and I said, you want a great stock, something that's completely off everyone's radar is Kodak. It was $2. I had it at $2. Then COVID hit, and it went to 3 or 4. Came down. I took a very small profit and got out of it. But the insiders are like loading up like crazy, and then the whole contract thing. But it was just weird. But I couldn't. I was going to the boots funding. I'm like, why are these insiders loading up? Well, anyway. But when you're trying to find these new ideas, it's not easy. I mean, you mentioned one, Blink. What do you like about Blink? It just being in the right sector? Is it better off in the charts?
I mean, in theory, if we're going to go along with the idea that there's going to be more EVs out there, right? We're going to have more need for one of the big things about EV and what has stopped me in the past and a lot of people is, okay, I'm going on a trip. I have to plan out where I'm going to charge this thing, right? Whereas if we're going on a trip with a regular car, there's a gas station every 5 seconds. Mm-hmm. So the difference is that we need more charging stations, and we need to have various places, whether it's retrofitted inside of a gas station or in addition to, or maybe in a Taco Bell or Chick-fil-A, or I don't know where, somewhere they have these charging stations. That's going to be a requirement to make sure that people can travel from place to place to place, assuming we go back to traveling at all. And therefore not having to have a home base that they come back to all the time. And of course, we have the battery capacity issue that keeps on expanding and getting better. And whether you look at the Tesla or some of the other car companies that are coming out, Lucid Motors or, Fiskars and whatever. But the thing is that, if we have a 300 or even a 400 mile range on the battery, there's nothing like, getting to that last level of battery charge, or gas in your car, not having a gas station around. So I think that that's an interesting thing. These Blink charging stations are something that's starting to perk up a lot of interest. And I think that is within the sector, and it has that tailwind of green.
Yeah, it definitely has a tailwind of green. And I want to talk about a subject here that I know you want to talk about as well, because this is something that hasn't really interested me for a while, even though so many people say, you got to get into this, Emerging markets. I didn't like emerging markets, and I love the U.S. because the U.S. was growing. There's pockets in the U.S. that were growing tremendously. There's sectors you could take advantage of. And that's why when you're looking at valuation, as long as your company is growing and putting up those numbers, it's being rewarded with their stock price. And Europe really coming down. China growth was slowing. Now, I mean, they've always been cheap, right? That's been the argument. They're cheap. Cheaper gets cheaper, right? It's the worst argument. But now you're actually seeing these economies grow and grow faster than the U.S. and coming out of this thing. It's someplace I'm looking at. I know it's a boring topic for everybody. Emerging markets. I got the U.S., but I really see opportunity where you can make a lot of money. What do you think about emerging markets here? And this is the first time you've heard me really talk about them, probably in a good 6-7 years.
We've held pieces and parts and larger and smaller of emerging markets as an asset class for a long time in our global allocations and in our investology strategy. And the reason for it is from a diversification standpoint, it makes a lot of sense. If you look at a chart going back and you kind of look at where is the number one regions and sectors been over time, emerging markets will kind of loop back and forth into the top, into the bottom, into the top, just like every other one. However, one of the things we have going for us right now with the emerging markets is, number one, they seem to, many of them, not all, Latin America is definitely not, but many of them have gotten a bit better handle on this whole virus thing, at least from the news flow that we know. Whether it's true or not is another discussion. Secondly, you have a dollar that's dropping. That's very, very beneficial to emerging markets. A weak dollar is very good for emerging markets. It makes their products it just makes everything, their assets kind of move up, because what's happening is you invest there and their currencies are moving up, and that's a good thing for them. Obviously, it's not good for some of the purchases that we make with that and the differential between the pricing of manufacturing, but they're still cheap as can be, and it makes a really significant benefit to them. And then on top of that, you have the fact that we still want to move away from areas in China. There's been a big move around the world to diversify our manufacturing and things away from China for all the different reasons we talked about. So you have different regions that are starting to crop up as alternatives to utilizing China, which could really take that emerging side of them to a much bigger level. So there's some great things that are coming out of those areas, and it's one of those things you want to have in a portfolio.
No, I definitely agree. So, run out of time here, and like always, I mean, I've known you for such a long time, man, such a great friend. I love you. So I always want to give you a chance to talk about, what you're doing, Disciplined Investor. You talked about Investology. And yeah, let us know how people can get in touch with you.
Yep. You can go over to the disciplinedinvestor.com. Check that out. That's right there. There you go. This is where our podcasts are. You can go to the button that says strategies, check out all the different strategies that we have and kind of scroll. Hey, look, there's Frank right there. Look, Frank, you see you with the helmet on? The Yankee
that is
there?
me.
That's you right there.
Podcast. That's me right there. Look at that. Yeah. I wish I had his body, though.
So we have different strategies for different people. It's been a great few months. The interest has been seriously to a point that we're like, okay, what are we going to do here? The amount of new accounts and new clients that come in have been astounding over the last several months. So thank you for that. But you can go there, check out all the things, listen to the Disciplined Investor podcast, find it on Apple, iTunes, Spotify, or anywhere else that's out there that you find your podcast. You can listen to DH Unplugged each and every week as well. So just reach out. There's a couple of different things. Ask us on the top of the site. There's contact us. Just find a way. And I'm going to give you something right now, Frank. I'm going to give you one stock to go.
All right, one stock to go. I'm writing it down.
I'm going to give you. I give you a few on the long side. I'm going to give you one on the short side. It's a speculative play. It's very interesting. Microstrategy, MSTR.
Mm-hmm.
Now, this company, Michael Saylor, I've known him for not known him, but I've known of him for a long time. Interesting company, great company.
Mm-hmm.
Yep. Basically bought $625 million worth of Bitcoin at an average price, about $15,000 sometime in November, December, or something like that. Doubled up on his money, but this, which yields him about, we'll just say he made $800 million or so from what we know about of the stock. The stock has been trading like it's Bitcoin. The stock market cap has doubled, one from about 2 billion to about, I think it went to about from 2 to 4 billion or $5 billion of market cap. So in other words, that incremental amount of 400 or 5 or $800 million of profit leveraged up the value of the company somehow about 2.5 times, which is absurd.
Yeah.
And if in fact you see that Bitcoin, if it starts to slide down, what happens to that valuation? It's not going to come in the form of earnings because unless they're going to somehow, which they may, move it from balance sheet assets somehow to the income statement. I don't know. Companies do strange things. It's possible. But we think that this is definitely overvalued for what it is. And just because they have balance sheet assets, which is good, is solid, doesn't mean that the company's valuation from market cap standpoint should be 2.5 times of what it was before, with only a small amount of incremental change from the balance sheet asset. So MicroStrategy on the short side is aggressive play, interesting play, something you may want to look at.
Mm-hmm. Very interesting.
So there you go.
I mean, I don't agree with what he's doing, and we established it, the CEO token. We're a publicly traded company now. I mean, I'm big fan of Bitcoin for many, many, many years, but I don't like the idea of putting other people's money and that balance sheet into it, because if this guy would have did this at 2018 January, he probably would have got fired 6 months later. So, and are other companies going to do? Yeah, it's cool because it went up and it worked.
He's been prodding Elon Musk to do this. He's been prodding Musk to do this.
He's been dead on. He's been dead right. But it's just for me, when I look at the responsibilities, fiduciary responsibilities, and you have a cash balance.
Terrible.
What happens if it doesn't work out? I mean, and Bitcoin could go to 3,000 or 5,000, which I don't see happening, but it could easily go there if our government decides, hey, it cuts everything off and says no Bitcoin.
I think there is the potential.
That is a risk where now, you crushed it. Right? Now you're crushing your investors. That's the thing I worry about. But listen, the guy's been right. You got to give him credit, though. But I hear you.
Yeah, I can totally give him credit. Two things. Prediction for next year, this year. I think that there's going to be a lot more talk about regulation, especially with the Biden administration around Bitcoin or around cryptos to a point. And I also think there's going to be some kind of discussion about regulation from the SEC about SPACs. Because if you really understand about SPACs and how they're working, they're great deals for the managers that put them together. That's why they're putting these things together left and right and just using all this money. But there's a lot of excess SPACs, going on. Guys,
it's fun now because everybody makes money. It's almost like a Ponzi scheme where even the last people getting in, which is mom and pop investors, are able to buy these things even before they take over a company and make money. However, the amount of money these guys make, and the reason why they're doing this, is because if you're Peter Thiel and you invested in Facebook, you can't turn around and sell that right away, right? It worked out fantastic, but it was like 7-8 years, right? This is, you have a pool, it's on a stock exchange, you're buying a private company, it immediately becomes public, and then your lockup periods a few months, they're gone. They're gone. A lot of these guys are gone and they get to cash out. And that's
this is the ultimate pump and dump. Ultimate pump and dumps.
Yeah, I'm not saying, DraftKings that way, it's fine. There's some that are good, but right now,
there'll be a few that will work out. Right.
There's like 65 of them or something, right? That are looking for, I mean,
there's probably 2 or 3 coming on market today. There was one today that came on the market.
I don't know. It's insane. But I did want to go quickly before we go. I want to say this because I'm looking at your podcast and I said the TDI podcast guest visualization.
Oh, yeah. This is a good one. Yeah, look at that one.
Who's this guy right here? You must really like me, huh? This is based on what? The larger and the more often they've been on the show. Man, look at me.
That is actually a algorithm that we built about the self-perception of the worth of the guest.
I love it. Love it. I love it.
Now that's how many times you've been on.
Yeah. No, that's cool, man. That's awesome. And another thing here,
and
guys.
Click that, Frank. I think that will take you right to, I think it's clickable, right? It should be clickable. It'll take to all the different podcasts that you were on, I think. Should.
Is it? I don't know.
No.
It was weird because it was actually the other way a second ago. But you know what? I just made this bigger, so maybe it's not. Anyway, but no, I mean, that's awesome. I really appreciate it. And one more thing I want to share with everybody, which, because you guys know Andrew, you see him on his Twitter account. He posts all these things. I want to show you the Andrew that I get and what this guy texts me all the time because he loves to cook and what he sees. And he texts me all this stuff. And then the big fish that you're catching with your family and stuff like this is, I used to say I used to say, when I die, I want to come back as Tom Brady. But you know what? When I die, I want to come back as you. I mean, you have unbelievable life. The pictures that you sent,
a lot of fun.
I got to get on your boat and really cool stuff. Really cool stuff, my friend.
Thanks for having me, Frank. I really appreciate it. Great show.
Thanks,
Keep up the great work.
Thanks for coming on, and I'll talk to you soon, man. Take care.
All right, great. Bye.